The FT ran an article recently celebrating that the FTSE 100, the index that holds the 100 largest stocks in the UK, had hit its highest level ever, eclipsing its 2018 level. And to be honest, I'm slightly in shock at this. Thankfully, I have Guillaume here to explain more. Is the UK, Guillaume, not under significant economic pressure?
Yeah, I think that's right, Peter. Like, the UK is actually the only member of the G7 where economic output is still hasn't recovered above its pre-pandemic levels. And actually, the projection is that it will still take a few years to get back up to those levels. So, as we know, the cost of living crisis has hit the UK quite hard. You know, we've had nationwide strikes, which are a good reflection of the poor economic sentiment. And you know, there's really more of an inflation issue in the UK because of availability of labor, and effectively that inflation has impacted household spending and confidence, and also forcing interest rates up. Not even to mention politics here.
Okay. So on the one side, we have a UK economy in or teetering on the edge of a recession, the cost of living crisis, really sharp rise in mortgage rates. And then on the other side, we have the FTSE 100 being celebrated for reaching an all-time high. What's actually happening?
Well, as we often say, you know, the market is not the economy, you know, when we try and sort of explain things. But, you know, in the case of the UK, it's probably even more relevant, you know, especially, you know, as you mentioned, the FTSE 100, that's dominated by large multinational companies. 75% of those revenues for those companies are generated from outside the UK. So in a sense, that domestic weakness is not necessarily present in those earnings. And especially, you know, you tend to get weaker sterling when the UK economy is weak. So actually, it can also benefit when you have to bring those profits back domestically from overseas because you got a better exchange rate. But if you look at the FTSE 250, you know, so the next 250 smaller companies, that's a much more domestically exposed index. And it's done much less well than the FTSE 100. You know, that FTSE 250 is down 12% from its all-time highs, which were in 2021. And really, that's where the UK fundamentals play out here. So we've had quite a large divergence between the two indices. You know, FTSE 100 has outperformed the FTSE 250 by 22% last year, which is remarkable.
Okay, I mean, that's an incredible divergence. I absolutely get that. But it's not just the domestic indices that it beat last year. It was its international peers. The S&P was down, you know, nearly 20%. NASDAQ was down over 30% in the same time frame. Why is there a big difference here?
Well, as we know, you know, the UK was always sort of deemed a bit of a boring index. You know, there's no tech stocks, there's no growth stocks in that index, or not as much as in the US, for example. And that's been a headwind for years. Too much mining and oil mining, banks, consumer staples, you know, not as exciting. But now actually what we're seeing is those sectors, that old economy, those sectors are back in vogue because high inflation, you know, is generally good for commodity producers who can have that pricing power and can pass this on to customers. So, you know, we just saw BP releasing its best results in a decade this week. It's also a higher rates environment, which is generally good for banks' profits, and the FTSE 100 has a bit more of those as well.
Okay, so I always, in my final question, like to put you on the spot. What's our view on this?
So as we said, you know, long-term performance remains unimpressive. You know, if you look since the start of the century, you know, despite higher dividends, you know, investing in US equities would have given you more than double the returns of the UK market. So there's definitely some room to catch up here still, despite last year's good performance. And for us, there's still attractive valuation levels in the FTSE 100, which gives you that margin of safety especially in case inflation starts to pick up again. Mm-hmm. So yeah, last year's outperformance doesn't mean that it can't continue this year.
Okay, so my key takeaway is that the market doesn't necessarily mirror the economy, and certainly in the UK, this is a really strong case in point for this. And also, really interestingly, I think when you mentioned, although the FTSE 100 has hit a high, US equities have probably given twice the return over the past 23 years since 1999. So not a great return. Guillaume, thanks so much, as always, for your time today. And we will be back again next week with a topic that's caught our eye. Thanks.